Ladies and gentlemen, federal employees, today we're talking about how you, as a Fed, can maximize your FEGLI, which is an ugly name, but it stands for Federal Employee Group Life Insurance. So your insurance you've got through the government. Because in some ways, it can be a fantastic program for some. In other ways, it could be an absolute terrible program for others, depending on your situation and your alternative. So let's talk about it. And if you're new to the channel, so good to have you. My name is Dallin Haas. I'm a financial planner who helps Feds with this sort of thing all the time. Whether it is your insurance, whether it's your retirement, your investment, everything, you can check out all the videos we do. We're here to help Feds get the most out of their benefits. So let's talk about life insurance, our favorite topic, right? We all love talking about life insurance. So before we go any further, we have to first answer the question is, do you need it? I have people trying to find the best place for life insurance, shopping around, doing all these things. When I look at their situation though, we have to start, do you need life insurance? Because if you don't need it, any life insurance is too expensive. Any life insurance doesn't make any sense if you don't need it, even if it's a good price. So the first question is, if you were to pass away, which I know sounds morbid, but important for planning, okay? If you were to pass away, would you leave anyone in a really tight financial spot? Some of the key reasons someone might get life insurance is you have minor children. You want to make sure you can get them raised and out of the house. Maybe you want to get them through college. Maybe you have a mortgage. You don't want to pass away and leave your spouse with a mortgage. Do you have other debt? These are some of the key reasons someone might get life insurance. Or let's say you own a business. I know maybe you're a Fed, but your spouse owns a business. Sometimes there are reasons to get life insurance on people that run businesses. I'm not going to talk about all those details because most of you are Feds, but you can look into that. The first question though is, do you need it? For example, most people, when they're young and they've got young kids, probably need some life insurance. Because you probably have a mortgage, you probably have some debt, you got young kids, or something happened to you, that would be really tough. But as people age, they get in their 40s, 50s, 60s, a couple things happen. First, they pay down their debt, and their assets seem to really start growing, right? Whether it's your TSP, whether it's your home value, your debt's coming down, your assets are going up. Hopefully, that's what we hope is happening. And your kids are aging out and growing up and leaving the house. All these things are happening normally right around retirement-ish, sometimes plus or minus. So for most people, the need for life insurance goes down over their lifetime. That's not everybody, but for most people. So most people don't need life insurance for their entire life. Most people just need it for some key times. And then once they get to a point where their debt is minimal or small or zero, and their assets are large enough, they as long as you can comfortably say, look, if I pass away, obviously emotionally, I'm sure my spouse, whoever, will be sad about it, but financially, they'll be okay. Because they're going to inherit the TSP and a piece of my pension and this and that, whatever it may be. That's the question. Do you need it? Answer that question first. And if the answer is no, fantastic. Maybe cancel your life insurance. Obviously, be careful before you cancel. It's hard to get things back once you cancel it. But once you're confident that you're good, you can cancel life insurance that you may or may not have. If the answer, though, is yes, and you say, yes, I actually do and want life insurance, then the next question is, where's the best place to get it? And it may be through the government, through FEGLI, and it may be somewhere else. Let's talk about it. Let me give you a rough idea of the government's program, and then you can decide whether it may be better or worse than the options you might have in the private sector. So the government's program has four different parts. We got basic, A, B, and C. Basic covers about your salary's worth of coverage. So if your salary is about $100,000, it's about $100,000 worth of coverage. They round up a little bit, but it's about your salary's worth of coverage. So if you were to pass away, your beneficiary would receive about your salary's worth. Okay. Next is option A, which is $10,000 worth of coverage. There's no way to increase how much it is. It's just $10,000 worth of coverage. So because it's not much coverage, it's never that pricey, but it's not that much coverage. So option A doesn't tend to matter all that much. Option B is where a lot of feds get into trouble because you can get a multiple of your salary up to 5 times. So again, if your salary is $100,000, you can do 1 multiple of that, 2 multiples, 3, 4, or 5. So you can get up to $500,000 of coverage with option B. And so because you can get tons of coverage, the price can be quite expensive. And for option B here, the price goes up in stair steps every 5-year increment of your life. So for example, age 45, 50, 55, 65, etc. In 5-year increments, it goes up in price. And you can look at the exact charts that'll show you exactly the pricing. But just let me summarize it for you. Once you're in your 50s, 60s, the price basically doubles every 5 years. Okay, so if you're paying $200 right now, at 50, at 55, it'll be $400, etc. Boom, boom, boom. It really starts going quick once you get into your 50s and 60s and later. It gets very, very expensive. So if you need it, fantastic. Okay, if you don't need it though, especially once you get into that older range, you want to look at, okay, how much longer do I need to do this? Because the price is really going to start creeping up. Option C, last but not least, this is a little coverage you get on your family, basically for your spouse and some kids. So you can get up to $25,000 on your spouse and up to $12,500 on kids. Basically, you pick a multiple of 1 to 5, and for each multiple you pick, you get $5,000 for your spouse and then $2,500 for each child. So again, the max it is $25,000 or $12,500 for kids. So it's not a ton of coverage, but if you just want a little policy for your spouse and kids, that would certainly get it done. But again, because it's not that much coverage, it never gets that pricey. So again, this is not a huge deal either. If you want it, you're welcome to have it. But really, what most people are going to be looking at is basic, which again is your salary's worth, and Part B, which is a multiple of your salary. So with that in mind, here are some thoughts. Part B, even in retirement, goes up every 5-year increment, and it gets insanely expensive. And if you do the math, you often will pay more into this in premiums over the course of your life if you kept it your entire life than the actual coverage amount if you lived into your 80s, okay? So it really gets expensive. It's not really designed to be kept your entire life. But if you already have this coverage, and you have, let's say, a medical issue, a health something where you can't just go into the private sector and get a medical exam and get cheaper coverage somewhere else, then maybe this is the best option for you. Maybe. I don't know. You have to make that call. But simply put, if you're in really good health, then you can probably find better pricing, better than Part B in the private sector with a good term life insurance policy. You could probably find better pricing if you're in good health. If you're not in good health, though, you may not be able to be covered at all in the private sector because if you have health issues, they may not want to touch you. Because Part B, or basic, as long as you have it right now, you can keep it regardless of your health issues. You can continue to keep it. And by the way, you can always cancel. You can always move down at any time. You can cancel your insurance. But if you want to increase your FEGLI, you can only do that at very specific times, like life events, like getting married, getting divorced, having a baby. Those sort of life events allow you, without a medical exam, to increase your coverage, which can be quite helpful. And during open season for life insurance, you can actually increase it without a medical exam as well. However, those don't really happen very often. The last was in 2016. The next one isn't scheduled. So before you go out and cancel anything, be careful, right? You want to be sure you don't need it before you cancel it. Because again, once you cancel it, it's much harder to go up later. You want to be careful. Now, last but not least, basic. This is the one, if any, that people keep into retirement. Let me explain the most common way people keep basic into retirement. There is, when you fill out the application for retirement, and assuming you're eligible to keep life insurance into retirement, let's assume that's the case, you're going to get a one-pager in the retirement application where you decide what to do with all this life insurance. There's going to be a question that says, hey, basic, do you want to keep it? If so, how much of it? Option B, do you want to keep it? If so, how much of it? Right? Those sort of questions. And for basic, there's an option called 75% reduction. 75% reduction. And by far, this is the most common option elected, at least that I've seen. There's other options, but this is by far the most common. And let me explain why. Let's say you retire at age 60. If you retire at age 60, then you continue, assuming you do 75% reduction for FEGLI, you keep paying the premiums at whatever rate you currently are paying. So if you're paying $40 a month, you keep paying $40 a month between 60 and 65. And during that zone, you still have the full coverage amount of your salary. So if your salary is $100,000, you have $100,000 worth of coverage in this zone, and you keep paying your current rate of $40 a month or whatever it is for you. After 65, though, things change. After 65, it actually becomes free. They stop charging for it anymore, but the coverage amount starts reducing down. Basically, it goes down by about 2% per month until it stops at 25%. Okay? So it'll start reducing down. Once it hits 25%, it'll stay there for the rest of your life. So if your salary's $100,000, it would move down until it's $25,000-ish. And then you'd have $25,000 worth of coverage for free for the rest of your life. Now, what happens if you retire after 65? If that's the case, then these reductions would happen immediately, and the premiums would be zero immediately, assuming you elect 75% reduction. If you elect not the 75% reduction, you want to keep more of your insurance, then this would cost more. But I'm just explaining this one option that is most common. Okay? So this is my summary. Do you need life insurance? If so, fantastic. What's the best place to get it? Is it FEGLI? Or is it, if you're in good health, maybe a private sector policy? Basic is by far the most common one taken into retirement at normally 75% reduction. Now, that's not a bunch of coverage for the rest of your life. So if you need a bunch of coverage, that may not do it, but it is fairly cost effective, right? Especially after 65, it becomes free. Option B is the big one that can get expensive over time. So just keep an eye on that one. Make sure if you need it, you really need it, and we'll go from there. So I hope that's helpful, and I'll see you guys in the next video.